Every headline screams the same story. Record debt. 38 trillion for the United States, 9 trillion for Japan, 315 trillion worldwide. Numbers so large they barely feel real. But buried inside those numbers is a question almost nobody asks, and once you hear it, you can't unhear it. If everybody is in debt, who is actually the lender? On paper, governments owe banks, funds, institutions, and their own citizens. But when you follow the ownership, trace the bonds, and map who holds whose IOUs, something unsettling appears. The world doesn't owe money to some outside entity. The world owes money to itself, inside a structure where the debt can never truly go away. That structure wasn't an accident. Over 3 centuries, 4 men, each in a different era, each solving a crisis, helped bolt together the machine we live inside now. One made government debt permanent. One made it global and interconnected. One made it infinite. One made it inescapable. Individually, their decisions looked technical, even boring. Together, they created a system where governments borrow forever, interest flows upward forever, and taxpayers fund the whole thing without ever being asked if they agree. Let's meet the architects of the debt trap. For most of history, state debt was brutally simple. A king needed money, usually for war, so he went to rich merchants, nobles, or foreign bankers and begged for a loan. In return, he promised repayment with interest, often backed by future taxes or seized land. If he paid, the debt disappeared. If he didn't, the creditors took the loss, or the king took the blame. Sometimes they were repaid with new privileges. Sometimes they were repaid with territory. Sometimes they were repaid with a sword. It was messy. It was dangerous. But it had one important feature. It ended. Debts were temporary. Either they were honored, renegotiated, or defaulted on. Then the slate cleared and the game reset. There was no concept of a government always being in debt by design. No permanent pile of bonds sitting on the books generation after generation. No central institution tasked with managing an ever-rising mountain of IOUs. That changed in the late 1600s. A Scottish entrepreneur with more failed schemes than successful ones walked into the heart of an empire and presented a proposal that would flip the logic of state borrowing forever. In that moment, public debt stopped being a short-term emergency tool and became a permanent operating system. His name was William Paterson. In 1694, England was broke and exhausted. King William III was fighting France, the treasury was empty, and traditional lenders were wary. England had a bad habit of defaulting. William Paterson arrived with a radical offer. He would organize a syndicate of wealthy merchants to lend the crown £1.2 million, a colossal sum. In return, he didn't ask for quick repayment. He asked for something far more powerful. Don't ever pay back the principal. Just pay interest. Forever. Parliament agreed. The deal? Merchants would deposit gold into a new institution, the Bank of England. The bank would lend that sum to the government. The government would pay 8% interest annually, funded by taxes. The principal would never be retired, only serviced. For the lenders, this was like buying a lifetime annuity backed by Parliament's taxing power. As long as the state existed and could tax its people, the stream of interest would keep flowing. And the IOUs they received, claims on that interest, could be traded like money. Here's the real twist. The Bank of England was granted the right to issue paper notes backed by this government debt. The state's obligation became the foundation for new money. Debt stopped being a temporary burden. It became a permanent asset class. The more the government borrowed, the more money the system could create, and the more tax revenue could be channeled upward as interest. The first bolt of the trap was locked in. Once England proved the model worked, everyone copied it. War was expensive. Empire was expensive. And now there was a way to fund both without ever facing the humiliation of fully paying down what you owed. France set up its own complex arrangements. The Dutch, long ahead in finance, formalized state borrowing further. And across the Atlantic, a young United States took careful notes. Alexander Hamilton, America's first Treasury Secretary, openly admired the British system. He argued that a permanent national debt properly managed, was not a curse, but a national blessing. Why? Because those who owned government bonds, wealthy citizens, banks, foreign investors, would have a direct interest in the survival and stability of the state. So the U.S. adopted the same core structure. Issue government bonds, promise to service them with tax revenue, create a liquid market so those bonds can be traded like financial instruments, roll them over instead of ever fully extinguishing them. By the 1800s, major powers were no longer asking, how do we get out of debt? They were asking, how do we manage permanent debt? Paterson's idea had spread. Government IOUs became the backbone of national finance. But something was still missing, a way to scale this system across an entire continent and then across borders, so defaulting on one debt no longer harmed just one lender, but threatened an entire network. That's where Nathan Rothschild entered the story. The Rothschilds began as modest money changers in Frankfurt. By the early 1800s, they had something no one else had: a family-run banking network embedded in 5 key cities: London, Paris, Frankfurt, Vienna, and Naples. Nathan Rothschild, operating from London, saw an opportunity. Governments were constantly desperate for funds, but borrowing was still clumsy. Each loan was custom negotiated. Markets were fragmented. Liquidity was limited. Nathan changed that by turning sovereign debt into a mass market product. Here's how his model worked. When a government needed money, Rothschild didn't just lend directly. He underwrote large bond issues, buying government bonds at a discount. Then he resold those bonds to a broad pool of investors: banks, funds, wealthy individuals. The government got quick cash, investors got tradable bonds paying interest. Rothschild sat in the middle, controlling issuance, pricing, and distribution, and capturing the spread. Information gave him an even sharper edge. During the Napoleonic Wars, his courier network delivered news faster than any official channel. Famously, after Waterloo, he used early knowledge of Napoleon's defeat to buy British bonds cheaply after a brief panic, then ride them up as victory was confirmed, making a fortune. But the real legacy wasn't one brilliant trade. It was structural. Rothschilds became the gatekeepers of sovereign borrowing in Europe. If a country wanted to tap the deep pools of capital, it went through them. And that made the system far harder to escape. Before Rothschild, a sovereign default, though ugly, was relatively contained. The king refused to pay, creditors suffered losses, and the game reset. Rothschild's innovation changed the stakes. Once government bonds were spread across borders and layered into countless portfolios, a default was no longer between a state and one creditor. It was between a state and an entire web of institutions and investors. Imagine a single British bond, issued by the government, underwritten by Rothschild, bought by a French investor, used as collateral by a German bank, pledged again in a loan to an Austrian industrialist. Now multiply that thousands of times across Europe. A default no longer just hurt one bank. It threatened pensions, commercial banks, foreign trade, and other governments' balance sheets. In that world, saying no to repayment became almost unthinkable. Political leaders knew that refusing to pay could trigger financial chaos at home and abroad, and turn them into pariahs in global markets. So instead of allowing the system to clear through defaults, the structure shifted toward eternal rollover. Refinance, extend maturities, issue new bonds to pay off old ones, keep the machine running, no matter how large the pile of debt becomes. Thanks to Rothschild's model, the trap tightened. Not only was debt permanent, it was now too interconnected to fail. Governments weren't just paying interest forever, they were locked into a network where stopping payment could bring the whole structure down. By the early 1900s, the United States had grown into an industrial giant, but its financial system was fragile. Banks were fragmented, panics were common. The money supply couldn't expand easily because it was anchored to gold and scattered reserves. In 1907, everything cracked. A stock market crash led to bank runs, credit dried up, the system teetered on collapse. One man stepped in, J.P. Morgan. He corralled top bankers in his New York library, forced them to pool resources, and orchestrated a private rescue. The message was clear. America needed a central institution with the power to stabilize markets and backstop banks. But Americans distrusted central banks, seeing them as tools of Eastern financiers. So the solution had to be disguised. In 1910, Morgan's allies met secretly on Jekyll Island to design what would become the Federal Reserve System. The branding was genius. Not central bank, but Federal Reserve. Not one monolith, but 12 regional banks. A public-sounding board, but with regional feds owned by private member banks. Behind the optics, the core power sat where Wall Street could influence it, the ability to create money and buy government bonds. When the Fed buys a treasury bond, it literally manufactures new dollars to do it. The government gets cash to spend, the Fed gets an interest-bearing asset, and the banking system gets a new reserve to lend against. This is how infinite demand for government debt was engineered. With a buyer that can print the currency it uses, there is no hard ceiling on how much the state can owe. The trap grew another level. Debt was no longer just permanent and interconnected. It was now effectively limitless. For decades, there was at least one constraint: gold. Under Bretton Woods, the US dollar was convertible into gold at $35 an ounce, and other currencies were pegged to the dollar. That arrangement limited how much the US could expand its debt and money supply. By the late 1960s, the math stopped working. The US had printed more dollars than its gold reserves could credibly support. Allies started demanding gold instead of paper. In 1971, President Nixon slammed the door, ending dollar convertibility. From that moment, major currencies became pure fiat, backed only by law and confidence. That also meant that debt and money creation could expand together without a gold anchor. Enter Paul Volcker. By the late 1970s, inflation was raging. Prices were spiraling. Trust in the dollar was eroding. Volcker, as Federal Reserve Chair, made a brutal decision. He hiked interest rates to nearly 20%. It crushed inflation, but it detonated something else. Throughout the 1970s, developing countries had borrowed heavily in dollars at low rates. Volcker's shock sent their borrowing costs through the roof. Suddenly, interest bills exceeded export earnings. Mexico, Brazil, Argentina, and others found themselves staring at default. This was another turning point. The spontaneous clearing of the system through default was once again on the table. Banks that had eagerly lent those dollars were now exposed. The cycle could have broken there, but the system didn't allow it. Instead, a new mechanism preserved the trap and extended it across the global south. When Mexico announced in 1982 that it couldn't meet its obligations, it wasn't just one country in trouble. Major US and European banks were staring at huge losses. A cascade of defaults could have wiped out big chunks of the Western banking system. Rather than let that happen, the rescue came through the International Monetary Fund and other official lenders. The logic was simple. Lend enough to struggling countries so they could keep paying interest to private banks. Attach strict conditions to those rescue loans. Preserve the appearance of orderly finance, even if the underlying debt was unpayable. Those conditions, known as structural adjustment, were harsh. Cut public spending and subsidies, privatize state assets, open markets to foreign capital, devalue the currency, prioritize debt service above domestic priorities. The original loans weren't forgiven. They were refinanced, restructured, and rolled over. The interest kept flowing. This was Volcker's unspoken innovation. When sovereign debt becomes mathematically impossible to repay, you don't wipe the slate clean. You lock countries into managed insolvency, forever paying, never escaping. The same pattern has replayed repeatedly. Greece in the 2010s, Argentina again and again, Sri Lanka recently. Rescue packages that secure repayment to creditors, paid for by austerity imposed on citizens. By the end of the 20th century, the architecture was complete. Permanent debt, globalized markets, central banks that print to buy bonds, and international institutions that prevent true default. From then on, the world wasn't just in debt. It was structurally designed to stay there. Fast forward to today, Global debt is roughly $315 trillion, about 3 times the size of the world economy. Governments, corporations, households, everyone owes someone. But zoom in and the picture becomes clearer. Take the United States. Around $38 trillion in federal debt, roughly half held by domestic institutions, pension funds, mutual funds, insurance companies, banks, and the Federal Reserve. The rest held by foreign governments and investors. That debt costs over $1 trillion per year in interest alone. Where does that money come from? Taxes and additional borrowing. In practice, it's a transfer from taxpayers and future taxpayers to the institutions and investors who hold the bonds. Globally, the pattern is similar. Japan owes mostly to its own institutions. Europe owes to European banks and the ECB. Emerging markets owe to a mix of foreign creditors and domestic elites. At the top of this structure sit giant asset managers, BlackRock, Vanguard, State Street, Fidelity, and large banks. They pool the savings of millions, buy government and corporate bonds, collect interest, and charge fees on top. So when you hear the world owes $315 trillion, it sounds like a looming disaster. But for the system's architects and beneficiaries, it's something else, an income stream. The planet owes money to itself, but that self is not evenly distributed. The bottom of the pyramid works, pays taxes, and services loans. The top of the pyramid holds claims on those payments. Debt isn't just a number. It's a mechanism for ongoing wealth transfer. So why not just pay it down? Why not run surpluses, slash spending, and clear the books? Here's the catch. In our current system, money is created when debt is created. Government deficits inject new currency into the economy. Bank loans create deposits. Bonds become collateral for more borrowing. If the U.S. government somehow paid off its $38 trillion in debt, it would be pulling massive amounts of money out of circulation. The same is true globally. Wipe out debt, and you wipe out the monetary assets on the other side of the ledger. That would mean a sudden collapse in money supply, crashing asset prices, bank failures, depression-level contraction. So instead of resolving the debt, the system refinances it. Old bonds mature, new bonds replace them. The pile grows, but the machine keeps turning, as long as confidence holds. Default would break the trap, but it would also blow up the very institutions and portfolios that hold the bonds: pensions, banks, funds, insurance companies. The people at the top of the structure have every incentive to avoid that outcome. The result is a strange equilibrium: debt that can't be repaid, interest that must be paid, a system that must not be allowed to reset. This is why every debt ceiling crisis ends the same way, with more debt. Not because politicians are uniquely incompetent, but because the architecture built over 3 centuries doesn't have an exit ramp that doesn't involve collapse. Once you see the pattern, it's hard to go back to the old story where government debt is just a mistake or a policy failure. It isn't. It's a business model. William Paterson made state debt permanent. Nathan Rothschild made it global and too interconnected to fail. J.P. Morgan helped engineer a central banking system that can create unlimited demand for that debt. Paul Volcker and the IMF made sure that even when countries can't pay, they don't escape. They restructure and keep paying. You live inside that machine. Your taxes, your interest payments, your savings accounts, your pension fund, they're all wired into a structure that treats eternal indebtedness as normal, even necessary. And most people are never taught to see it. They're told, debt is a problem we'll fix someday, while the interest quietly flows upward year after year. I'm not telling you this so you panic. I'm telling you so you stop being naive. Once you understand how the system was built, you can start asking better questions. How do I position myself? What assets do I hold? How do I avoid being the one always paying the rent on a system I don't control? If you want to keep unpacking how this machine really works and who it really serves, hit subscribe, turn on notifications, and stay with this series. The rules won't change for you, but your understanding can.